Thank you very much, Chris. Thank you, everyone, for attending and staying for the last presentation. And the last one is going to kind of bring us full circle, I think, back in the world of UK-focused investment trusts, much like the first presentation. So you might hear a few echoes of what Temple Bar said at the start in this one. And investment trusts generally are a bit less exciting than some of the other companies we've heard from. But in their own way, investment trusts this year are having a bit of an exciting time. And you can see that in a not particularly good way by the discount at the moment. The discount on your average UK investment trust is right at the bottom end of its historic range, so 10%. You can buy them pretty cheaply. And that has been crystallized in recent months by the headlines we've all seen from the US investment house Saba kind of attacking UK investment trusts and trying to arbitrage that discount and take advantage of buying things cheaply. So it's a sector that is back in the spotlight this year, and it's worth, I think, reminding why investment trusts are of merit, why we think they're such good investments for people. To start with, you've got the management structure with a board of directors who act in your best interests and keep managers in check. The closed-end structure genuinely allows for long-term investment. We're not at the mercy of outflows, which means we need to worry too much about liquidity, and it means we can hold less liquid investments and we can think genuinely long-term as managers. It gives retail investors access to very diversified portfolios, and importantly, we can lever up. So that use of leverage through cycle enhances returns, and from a Shires point of view, it enhances income, which is really useful. That income can also be smoothed through cycle. So the income that we pay to shareholders doesn't need to be directly linked to the income we generate in the portfolio. But what is always important for investment trusts, and why some trade at discounts and why some get challenged, is they need to actually provide something that shareholders value. For Shires, the thing we focus on is a consistent, reliable, high level of income, and one that will be maintained through cycle, but we also try and deliver reasonable capital growth at the same time. We can show that by showing the historic yields over time. We've tended to trade around 6% dividend yield for Shires. That compares to the benchmark, which is now about 3.7% in the UK. So we are delivering access to UK equities, but with a really significant dividend yield premium, which is important for a lot of shareholders. My compliance department made me take off the lines there, which I was going to show, showing bond yields and showing cash yields at the moment. And our yield would have been consistently above what you could earn on cash as an investor over time. But in recent years, we have seen cash returns go up. You would have seen, a cash ISA, you can get 4.5–5% at the moment. So it's also worth just touching on why you might think about equities for income rather than sticking it in a cash ISA while you still can. Current yields, if we compare cash bonds and equities, if you look at the market, you can get a better yield on cash and bonds than you can on equities at the moment. And that is attractive. But of course, there are other reasons to own equities for the long term. The most obvious is the long run real return is simply better from equities. But also over time, you can grow income from your equities. If you buy an individual stock, generally, dividends go up. If you buy a diversified portfolio, dividends should grow over time, and we have grown the dividend from the trust over time. You won't get that from cash, and from bonds, of course, your coupons are fixed. They're also a much better inflation hedge. So in a world where inflation has come back recently and where it is unlikely to go away quickly, bonds and cash, your real returns will be harmed by inflation. Equities hedge out inflation much better than that. You also have, in effect, a perpetual investment. Dividends will keep coming from an equity stream, whereas if you have a cash ISA this year, the rate might be not be the same next year. Bonds, when it comes to the end of its life, you need to reinvest and you have uncertainty over the income you will get. The downside, of course, capital is more at risk with equities. They are lower down the capital stack, whereas cash, you will definitely get your cash back. So we think income should remain important for investors, and it should be particularly important for investors in our view at the moment. A couple of charts to show you why we think that way at the moment. If we look back over the long term, then income feels like it's a little bit out of favour at the moment. It feels like everyone has made their returns from US tech and from capital growth. But in the UK, on a rolling 20-year basis, income has made up over 2/3 of your total return. So it's pretty important. In Europe, it's around half. Even in the US, after a period of really unprecedented capital growth, it's still about 1/3 of your total return. So income matters. Of course, at the moment, we're in that environment where returns from the market have been enormously concentrated in US tech. So you can see in the small chart at the bottom there, market concentration is basically the orange line. The concentration in the top stocks in the US market is as high as it has ever been. And indeed, it's very concentrated in those top ones. If you even go down to the next 10 stocks, they don't make that much difference. That creates risk. And a really interesting chart I think all investors should be aware of at the moment is the one on the bottom right there, which shows you the relationship between valuation of the equity market and future 10-year returns. And it feels like a bit of a cheat code that correlation is so high. But when the market trades at this level, as it does at the end of last year, then your 10-year forward returns from market level historically have been pretty close to 0%. So although we have made a lot of money from capital in recent years, don't necessarily expect that to continue for the next 10 years. And that's why generating a return from income at the moment is particularly important. So that's kind of why income at a high level. Why UK? UK is cheap. I think I'm bored of giving presentations where I say the UK is cheap. It definitely is. The chart there, similar to the one from Temple Bar, shows you the UK forward earnings multiple relative to the US. The dark blue line is absolute terms. The light blue line is if you adjust out all the sectors, so the sectors are equally weighted. And the UK versus the US is as cheap as it has ever been. That's very true. But I feel we've been saying that for probably 5 years, and it hasn't changed yet. I think it will change, but you can't rely on it. The nice thing about the UK at the moment is you don't need to rely on that change. The chart here shows you, and you will have seen this one earlier, net buyback yield and dividend yield from all the major markets. The UK is on the bottom left-hand side there, and if you add up that distribution yield at the moment, you get to 6.7%. If you think of long-term real returns on equities at just under 7%, then what that is telling you is that you get your expected long-term equity return just from those distribution yields. Putting earnings growth and re-ratings to one side, you therefore don't need the UK to re-rate to generate a very attractive through-cycle return at the moment if you buy and hold. And that differentiates it quite clearly from other markets that you can invest in at the moment. One of the challenges the UK faces is that it's very much a value market. It doesn't have as much growth as some other things. And that has held it back quite significantly in the last 5 years. The chart here is a very long-term chart showing value versus growth performance. Areas of blue on the chart show you when value outperforms, areas of red show you when growth has outperformed. And a lot of people working in the investment communities today don't believe this. They don't believe that growth wasn't ever the best thing to invest in. But actually, it's only really this last period of low interest rates when growth has outperformed materially. As interest rates have come back up, we've seen value start to gain ground again. And the UK, being a value market, is much better positioned in that environment than it has been over the last 15 years. So, turning to Shires and what we do. What we try and do is a differentiated strategy for income investing. So we are a UK income trust. We invest primarily in UK stocks, but we differentiate ourselves by having around 20% of the portfolio in preference shares and fixed income. And what that does is give us a nice block in the portfolio that is very high yield. So the chart at the bottom there just splits out the portfolio by yield buckets. The things over on the right-hand side are the things that yield more than 6%, including the preference shares. And they don't grow, but they deliver very, very reliable source of income over the long term. And what that means is for the rest of the portfolio, we can be much more diversified. We are not chasing high yield stocks necessarily, and we are not getting stuck in value traps where we have to have that high level of income. So we end up with a nicely diversified portfolio. We can hold overseas equities as well to add diversification, although at the moment, because the UK is so cheap, our overseas holdings are actually pretty low. And we invest with a genuine multi-cap and style agnostic approach. Historic yield of 6% is very attractive, but we target dividend growth as much as we target dividend yield. So the bars on the top right chart just show you the dividends growing over time from the trust. And I always like to say this chart doesn't quite do it justice, because in there is the period in 2020, 2021, where you had the COVID crisis, you had the greatest fall in history of dividend generation from our benchmark. But the trust structure and our focus on quality and preference shareholdings meant we maintained our dividends and then grew them immediately afterwards. The focus on dividend growth is shown in the bottom chart there, and as well as having a higher yield than the benchmark, if we look at the portfolio positions in aggregate, the expected dividend growth over the next 2 years is significantly higher than the benchmark. So the benchmark is about 3%. We are right over there, about 13% at the moment in terms of expected dividend growth. I mentioned the size and style agnostic approach. You can see the chart on the top right showing positions by market cap and forward dividend yield. The bubble sizes show the size of the position, and the point it's making is that we are really spread by market cap. We've got huge cap companies like Novo Nordisk or SML, all the way down to small companies on AIM or in the FTSE All-Share market. And our position sizing tries to be very unaware of the benchmark. We want to be independent of benchmark thinking. The bottom left chart just shows you where we're positioned at the moment. So one thing we particularly like at the moment is UK small and mid caps. We think they offer really good value. Generally, they outperform through cycle. At the moment, they are cheap because they tend to perform badly when interest rates go up. So it's an opportunity now, after interest rates have risen, to get some of that growth from UK small and mid-cap companies in the portfolio, which will aid performance in future years. And you can see relative to the benchmark there, we are roughly in line large value. We don't hold much large cap growth because we think it's quite expensive, but we're quite obviously overweight mid-cap growth and small cap value versus the benchmark. This slide is quite busy, but it kind of shows you that we do what we say we do in the portfolio. So the blue bars on the left show you value. We are overweight value at the moment. I think Temple Bar gave a great description of why value works at the moment. That's something we agree with. We think the UK is a great value market. The next bars show you we are very much overweight dividend yield and dividend growth, so a kind of quantitative proof that we are doing what we say we do. And then the purple bars are quality. And we talk a lot about quality. We care about quality and we want to own quality companies. So we are overweight some quality attributes like return on capital, return on equity, but we are underweight earnings stability, for example, because we are happy to hold things through cycle. We are happy to take on more cyclicality. We like things like banks and energy where we can buy them at a down point in the cycle and hold them, and therefore we will take more volatility in the portfolio. In terms of what we've been doing recently, these are things we bought in the last 9 months. And if you went down the names, I won't go through them all, you would see a great diversity of holdings. So things there like Conduit, a relatively small cap UK reinsurance company, all the way up to something like ASML, which is a giant tech company. We tend to look at companies on their own merits. We're not necessarily worried about how the size, but we are consistently looking for either high dividend yield or high dividend growth potential in future years. And feel free to ask us about any individual stocks. But I picked out a few examples to kind of show you the kind of thing we're looking for. And first thing we look for is underappreciated quality. We really want to own quality companies, but we don't want to pay for them. And that means we're looking for these examples where things are getting better and the market hasn't quite realized it yet. So Kia Group is a great example of that in the UK market. If you followed UK construction stocks over the long term, you would know it's been a really difficult place to invest. Stories like Carillion have seen collapses historically. But out of a great crisis comes much better investment performance. And it's that classic capital cycle story where the sector has gone through repair. You've seen consolidation into a smaller number of companies. Contract structures have changed to protect those companies, and balance sheets have been repaired. And you now have an outlook where you have maybe 4 or 5 large-scale UK contractors selling into a genuine growth market. UK spending in energy, infrastructure, water, etc. is going up and has to go up over the next 5 to 10 years. So a company like Kia, you can buy it at a very low valuation, but actually the outlook for earnings growth, cash delivery is very good. Another example of finding underappreciated qualities going down the market cap spectrum, so finding the small things. ME Group is a company that operates photo booths and automated laundromats. This is not NVIDIA and the glamorous end of the market, but the great thing is it's highly scalable. The automated laundry business is very high return on capital, and it has grown materially over time and has a great runway for growth going forward. So the kind of thing that actually screens as very high quality, but isn't valued that way by the market. The other thing we're looking for is valuation opportunities. So where things have maybe gone wrong, maybe where there's a change and things are then getting better to give us a great valuation opportunity. Reckitt Benckiser is a very large cap consumer staples company. Generally, we don't like consumer staples particularly because growth is modest and the market does like them, so pays quite a lot for them. But Reckitt's had been through quite a challenging time. It had had various legal challenges and it had been underinvested over time. But what it did have was a great portfolio of brands that can deliver long-term growth. So we waited until we found a valuation opportunity for Reckitt's that we could buy, and it has started performing well, but it's one we think has good compound growth for years to come. Serica Energy, another one in the energy space, which has been super difficult, and a relatively concentrated business which had been harmed by operational issues and by UK tax changes in the North Sea. But everything has its price, and Serica had taken the right action to address the tax position and had changed the management team to get in a much more operationally focused management team to make it perform better. And that was an opportunity for us to buy something with about 30% free cash flow yield, 19% dividend yield, and now we can be patient, wait for them to fix the operational issues, and I think it will deliver a very good return. So thank you very much. I'll wrap up there. Hopefully I've communicated the importance of income, why we think it's really important now, why the UK is really well placed to benefit from that, and what Shires can offer to retail investors.
Okay, questions in the room? Okay. Gentleman at the back. Thanks, Steve.
Thank you, Iain. Quick question, a couple of questions. One is in regard to the dividend yield, 6%. I'm struggling to figure out what's the additional gain per excess risk that I take in on equity when fixed income yields and treasury bonds 10 to 30 years are keeping me 4.5% and 5%. So 6% dividend yield sounds not enough to compensate for the extra risk that I take in. And the second question is the long-term capital growth, which I think that if part of the question is I've been following Sabbath situations since the beginning of the year, and I think that I'm looking for the long-term capital growth, but I expected that the discounts going to be closed somehow. Otherwise, it's not generate the gain that I expected in the long run. So, do you think that there is something else to be done to first increase the yield, the dividend yield? You mentioned 15% from that company, Serica, which is brilliant. We need more of those, but also closing the gap? That's my question.
Yeah, good question. I mean, the trade-off between bonds and the yield we offer, look, there is a trade-off there. The main difference I would say over the long term is that you can get your 4.4% bond yield. That coupon is not going to grow. Whereas I would definitely hope, I definitely wouldn't promise, that over time our dividend per share will grow. And we've shown we can do that. So you might earn 6% yield today, but if we grow that dividend, your yield on your in price in year 10 might be 7%, 8%, for example, if we grow the dividend as we should do. So over time, that compounds up. And the capital should hopefully grow, won't grow all the time, over turn as well. So there is I see it as a beneficial risk-reward trade-off. But debating the merits of different asset classes is a big question. In terms of closing the discount, yes, I think there's a lot of kind of hand-wringing in the investment trust sector about why the discounts are as wide as they are. I think liquidity is one issue. I think we've just come through a period where a lot of investors expected capital gains tax to go up and therefore sold positions ahead of that event, and that increased discounts. And I think the UK market is a little bit unloved, and that causes a discount as well. How do you close it? I think consistent performance, increasing yields is one way to do it, for sure. I think a higher yield can close the discount. But you want to be careful you don't grow too fast and over-distribute and put yourself in a position where you need to cut the dividend. That's not
Okay, brilliant. Thank you very much, Iain. Thank you.